Right, right. We also have Basant with us. Hi, Basant. How is everything going? How are you doing?
Hi, Sejal. All well. Thank you.
Right.
Thanks for hosting this.
Absolutely. So we will start the space officially around 8:35. तब तक के लिए we'll wait for the audience to join in, so more and more people can join in. And I would also share the link above, so you guys can retweet, reshare, so more and more people can join in and probably learn from the space regarding debt funds. What are debt funds? How do they work? And the ins and outs. So I have just shared the link above, and you can retweet that. And I look forward to the session today. तब तक के लिए if you would like to discuss something just for 4-5 minutes, more than happy to do that. And we also have Joydeep with us. Hi Joydeep, how are you doing? Am I audible?
Yeah, yeah. Am I audible?
Yeah. Hi Joydeep,
Yeah, yeah.
how are you doing? What's up? What's going on?
I'm doing great.
How?
So,
Right, please
great. Huh.
go ahead. You were saying something. Please go ahead.
Haha. So the mood is positive now after the successful landing of Chandrayaan and all. The nation's mood is positive.
Right. Right. Absolutely. It is a day of a lot of pride for every Indian. And Pragnanda came second in the
Yes,
championship for chess. There is India who landed. It was the first country to land in the southern half of the moon. So a lot of things are going
yes.
on, and there's so much going on, so I think that is quite good. And today we have this space, obviously not as big as those achievements, but again, this is good, right? There's a bunch of people who've joined in today, and they want to discuss how debt funds work, what are the ins and outs. So I look forward to this space. We will just start in the next 2-3 minutes. I see a lot of people sending requests as speaker as well. I will just add all of you people, and let's go ahead with the space. Right. So 2 minutes are left, and tab tak ke liye we can just start with some initial discussion to make start some foreshadowing for the space. So sabse pehle, there are so many categories of funds available in the market. There's equity mutual funds, there's debt funds, there's direct equity, there's FD, and there's also other ways of investing. So what are debt funds and how should one go about it? Let's start with this question. Basant, am I audible? Let's go ahead with you first as the speaker. Hello.
Sure.
Right. So, Basan, what are debt funds? And like, if there's a multiple categories of funds available in the market, why should one consider them? What does a debt fund, comprise of? And what is the basic mechanism of how debt funds work? How are they different from equity? इससे start करते हैं.
Sure. So debt funds are basically a pass-through, just like any conventional instrument. So when an investor invests in a debt fund, the fund manager will basically invest the same in debt securities in line with the mandate of the fund. And this is basically considering the broad regulations within which the fund operates. So these debt securities are nothing but obligations of the entity whose instruments I, as a fund manager, am purchasing. In terms of the mechanism,
Right.
all mutual funds, be it equity or debt, are similar in the sense that it remains a pass-through for investors to take an exposure to a particular asset class. So for a debt, debt mutual fund, you are taking an exposure to a debt instrument, underlying debt instrument, and for an equity mutual fund, you are taking exposure to an underlying equity instrument. Now, any debt fund would have a portfolio of securities which essentially diversifies the overall exposure of the investor. There are limits that are defined by the regulator in terms of a single issuer. So, what sort of exposure that I can have to a single issuer or a group. So, if there are group companies within a single, like for example, the Reliance Group, uh, it may have various, underlying companies within the group. So, what kind of exposure I can have to the overall group, sector limits, duration limits, and so on. The overarching structure of any fund will be available in the scheme information document, or SID as we call it, and that will be available on the website of any AMC whose fund the investor is considering. Now,
Right.
each fund is typically defined by two attributes, the fund's duration and the yield to maturity. The yield to maturity is basically nothing but closer to the actual returns that the investor can realize if the investor remains invested in the fund till the duration of the fund. Just as a layman, so for example, if I invest in a fund that has a duration of 1 year, and for instance, if the yield to maturity of that fund is say 7.5%, at the end of the year, when I want to withdraw my funds, then I can reasonably expect to realize returns close to 7.5%. Uh, as compared to an equity, equity does not have a definite maturity date. So the investment horizon and risk appetite is completely different. Also, it also depends. When you're looking at a debt fund, you also need to look at your investment goal. So, for example, if you are planning to buy a house after a year, and if you're looking for, say, for instance, safety of your principal, you could invest in a fund which has a duration of 1 year, and so on. So you can have different investment goals and plan your investments in a particular fund which has a duration which is appropriate to your risk appetite and the duration of your investment.
Right. So, Basant, I have a follow up question for you, right? Because these spaces are meant to simplify everything for investors and understanding different kind of
Sure.
securities. तो अगर हम इसको थोड़ा सिंप्लीफाई करके बोलें, तो अगर एक डेट फंड होता है, वो एक इक्विटी म्यूचुअल फंड में तो वो हो गया कि वहाँ पे इक्विटी स्टॉक्स खरीद रहे हैं मैनेजर एंड वो सारा मैनेज कर रहे हैं आपके लिए म्यूचुअल फंड में, राइट? बास्केट ऑफ
Sure.
स्टॉक्स. सो जब हम डेट की बात कर रहे हैं, तो डेट के अंदर अगर हम एक जनरल में कॉम्बिनेशन की बात करते हैं, डेट में क्या क्या हो सकता है उसकी बास्केट में?
So, debt instruments broadly can be classified based on either a maturity or an interest rate.
राइट.
Now, based on maturity, debt instruments can mature either on a fixed date, uh, just like an FD. You book an FD matures at a particular date, and you realize your money at the end of your investment horizon. Similarly, debt instrument can have a fixed investment horizon, or you have very structured sort of debt instruments as well. So debt instruments can also mature in a staggered manner, wherein, say, for example, if you have an investment of 5 years, that particular debt investment can have specific terms and conditions. For example, 20% redemption at the end of each year, uh, and then the final 20% gets realized at the end of the fifth year. Or it can be a subordinated debt, like a tier 2 bond issued by a bank, or it can be a perpetual bond, like an additional tier 1 bond. uh, and each, based on the maturity, based on the structure, the interest rates get decided. And in terms of the interest rates itself, debt instruments can either be issued at a fixed rate of interest, so the rate of interest is fixed for the entire life of the instrument, or based on a floating rate of interest, wherein the interest rate is linked to a particular benchmark, just like a home loan, for instance, wherein the rate of interest can be linked to a bank's MCLR.
Right. Thanks for sharing that, Basant. Now going to Prableen. Prableen, would you like to add to that or probably give some of your views?
Okay, same questions, Sejal?
Yes, if you'd
Yeah,
like to add
okay.
something beyond that.
Okay. Okay, so because you were asking, I think, to simplify, so I'll try and simplify it further. So basically, see, whenever there is a company, there is a business, and it requires money, there are different ways of getting that money. One is that if you're a listed, I mean, when you're listing your company, you're selling the shares, and people subscribe to it, and then it's on the prospect that the company would grow in future. The other way is to borrow money from a financial institution, a bank, it's a loan. And the third way to raise money, borrow money, is by issuing bonds. So it's just like, when you're in college, you sort of lend your friend, let's say, 1,000 rupees, and your friend says, "Oh, I'm going to return you 1,200 back." So that's like, it's the same way debt funds also operate. They are basically buying these bonds, and they are lending money to these different companies, and it is of course on the promise that they are getting a certain interest back on it. And there is, like Basant mentioned, there are three things: that there is face value to it, then there is a duration for that bond, and there is a set interest rate. And you keep getting that interest rate, and that is how the NAV of the fund also keeps going up, because any debt fund will have these different bonds as its constituents, which can be government bonds. They can be in the form of state development loans, they can be in the form of treasury bills, or bonds and papers issued by different corporates, let's say like Reliance, even banks like HDFC, L&T, these big companies. So different companies issue these bonds, and mutual funds basically, make a portfolio of these different sort of papers and bonds, and as they keep getting the interest, the NAV keeps going up. And the other way that the debt fund, let's say, earns, or the way NAV moves, is that the bond price and the interest rates, they are inversely proportional. So whenever there is a movement in the interest rates, there is an impact on the bond price which they're holding. And like Basant is a fund manager, they're managing money for investors. So they buy or sell these bonds in the markets, and that's again how the NAV keeps going up for the debt fund. So broadly, it belongs to the category of fixed income instruments, where we do look at the up and down movement in the NAV, but it is not as steep as in case of an equity fund. The volatility is much lesser, so it's put in the category of a fixed income instrument. And this is basically for investors who want more predictability in returns, who are looking at parking money for a time, say for a week to 10 days to 10 years and more. So we have different categories of debt funds, and I think there's a debt fund suited for every investor out there. And I think it's a wonderful asset, it's a wonderful product, and I think very underutilized, honestly, by the retail investors. Sejal, I think it has a lot of benefits. Even doing, an SIP in a debt fund actually is a great idea.
Right. So I do have a follow-up question for you, Prableen.
Right.
So what are potential returns one can expect from debt funds? That is one, because you said you
Mm-hmm.
can do it for very 1 week and आप 10 साल तक भी जा सकते हैं इसके अंदर.
Mm-hmm.
So probably potential returns is one that I want to understand, and also are there any risks associated with debt funds compared to equity, and एक risk profile एक person का क्या होना चाहिए जो debt fund में invest कर रहा है?
Okay, so let me answer the question on returns first. So returns would vary, Sejal. Let's say you have to go in, buy book an FD in the bank. So the interest that you're getting for a 10-day FD to a 6-month FD to a 5-year FD, that also varies. The longish horizon, because you're committing your money for a very long time with the bank, they usually offer you a better return, right? But it's in the range of, let's say, that 1.5% difference overall. So debt funds also work in a similar way, depending on, for which product you're picking, what kind of a duration maturity it has. The returns, the predictability, is different, and the return that you can get is also different, but it would be in the range of whatever broader interest rates in the economy, around that. So let's say if the interest rates in the economy currently, let's say it's like a 10-year bond is about 7%. So almost all debt funds would be in the range of, let's say, 6.5 to 7.5, sort of a spectrum. They would move in that range currently. So I think the broader interest rates in the economy, that gives you a benchmark that it would be around that percentage. And because there are a lot of nitty gritties and further complexities how these funds move, so it would be, category wise, that I think it'll be easier for the investor to understand what is the return that he can or she can get from the investment. And the second question was the risk, right? So risk, there is no reward without risk, of course. So yes, risk is there, but a different kind of risk. One is the credit risk. So credit risk is like, you give me money, I borrow 1,000 rupees from you, and I don't return that money, Sejal. So that is your credit risk. That when we lend money, the person doesn't return it. And it can happen even with companies if their financial situation goes bad and they are not able to return the interest payment or the principal. So that is the credit risk which these funds carry. And that is why almost all debt funds have some component of government securities and state development loans, and the bigger names. And let's say if you have two friends, that one gives you your money back on time and the other one is always there is some sort of an issue while he or she is returning your money, that friend will always entice you with a better reward. Okay, Sejal, lend me some money. I'm going to reward you with this thing. So smaller companies we'll see are offering better interest rates. So whenever you're looking at returns in a debt fund, if you see that the YTM, what Prasad mentioned, is really high, you must understand why is it high. It'll be high either because of a higher credit risk or a higher interest rate risk. And interest rate risk generally is higher when we are locking our money for a longer time period. So I think these two are the broader risks. And I think as we go further, probably we can understand the liquidity risk as well.
Absolutely. Thank you. Thank you so much for that, Prablin. And now coming to Joydeep. Hi, Joydeep. Am I
Hi.
audible?
Yes.
Yes. So, Prablin's mentioned that there are different categories, etc., etc. So, firstly, what is the difference between short term and long term debt funds besides the time horizon? That is one. And also, what are liquid funds? Can you, share some characteristics of liquid funds as a type of like a short debt fund? So, just throw some light on different categories of debt funds, please.
Sure. So please allow me 1 or 2 minutes before I come to this particular question. In the context of what has been already discussed between you and Basant and Prablin, you initially said there are multiple investment avenues in front of the investor, which is there. Just to talk a bit, 2 bits on that. So let me bifurcate. There are staple investment avenues and there are alternate investment avenues. Among these staple or more regular investment avenues, we have mostly equity, then debt or fixed income, and to an extent gold. And in the alternate space, we have certain other investment avenues. I say, for example, riskier equity like unlisted equity or what we call PE or VC, that is private equity or venture capital. It could be unlisted debt, and there could be other commodities, as in non-gold. Now, these are not really very usual, very regular, so they are called alternate. Now, within the staple investment assets, like I said, it is mostly equity and debt, and to an extent, gold. Now, coming to the fixed income or debt component of the portfolio, what are the choices in front of the investor? Again, here there are multiple choices. Of course, debt mutual funds are there, which we are discussing. Then, as you said, there are bank FDs. You simply go to the bank and book an FD. And there are direct bonds. In the sense, like in equity, you can invest in an equity mutual fund or you can buy an equity stock through a broker. Similarly, in debt or fixed income also, like the bonds which have been discussed, you can directly buy the bonds. Now, what is the issue there or what is the comparison there? FDs are easy. You just go to a bank and book the FD. Now, in a bond, the issue is the bond market is typically wholesale in the sense the players who are there, they are the big boss of the market, like banks, insurance companies, mutual funds, and the market is not really retail. So, if you have to buy something from the secondary market or sell something in the secondary market, it is possible. But the market being wholesale in the sense the usual trading lots are much on the bigger side. So not really easy or accessible for the investor. And that is where mutual funds come into the picture. In a mutual fund, you can invest for any sum of money, like be it 5,000 rupees, be it 5 lakh rupees, be it 5 crore rupees, or whatever the amount you can invest in a mutual fund. And then comes liquidity. In a mutual fund, liquidity is easy. You just put in the redemption request and you get the money next day or day after. Another thing I want to clarify here, particularly for the listeners, coming to fixed income mutual funds, investors have a fixed deposit mindset in the sense, in a fixed deposit, whatever the bank say, as an example, 7%. In simple language, bank ने 7% लिख के दे दिया, so the investor can safely assume 7%. Now, in a mutual fund, as per regulation, a mutual fund cannot commit any return. So what we are saying, that is like, as an example, if the portfolio YTM is say 7.5%, so then there is an expense ratio as well. So net, whatever is the, what do we call the net running yield, that is portfolio yield to maturity minus expenses, that is what we indicate to investors as an expected return. But mind you, it is not a commitment, not a guarantee from the mutual fund. So that is what the people should keep in mind. Now coming to a particular question, what are the mutual fund categories and long duration and short duration and all that? So for the categorization of mutual funds, so earlier days prior to 2017, it was kind of flexible and left to the mutual funds. So in October 17, the regulator SEBI, they brought the circular, which was implemented in 2018. Now in this, as per this SEBI circular, there are 16 debt fund categories. And the criteria is mostly the portfolio maturity of the fund or the portfolio maturity of the instruments, maturity instruments in the fund, and to an extent the credit rating of the instruments in the fund. Plus, there are certain other fund categories like fixed maturity plans and target maturity funds and those kind of funds. Now, coming to your question, short and long. So, usually what we say is a fund, a debt mutual fund with portfolio maturity which is not too long, which is on the shorter side, is a short duration fund, and one with a relatively longer portfolio maturity is a long duration fund. Now, what does it mean? So, like duration. So, duration is a technical concept. The English word portfolio maturity or maturity of a bond is same as the English word. Whereas duration is a technical word, what it means is the extent of variability along with the market. So, like Veblen said, in the market, yield and price move inversely. So, whatever be the movement of interest rates in the market, for example, inflation goes up, inflation comes down, RBI hikes rates, RBI cuts rates. As a consequence, what is the extent of movement in the price of the bond that is given by the duration of the fund? So, in a mutual fund scheme with a longer portfolio maturity and longer portfolio duration, the variability will be higher in the sense when yield levels come down, interest rates come down, the fund will gain more, and vice versa. When yield levels move up, interest rates move up, the fund will lose more. And a short duration fund will be relatively more stable. There also the impact of market movement will be there, but relatively less. The fund will gain more when interest rates come down, and the fund will lose less when the interest rates move up. So again, this is more of a colloquial this thing. So as per SEBI categorization, there is a category called short duration fund, where SEBI has laid down what should be the maximum portfolio maturity. And there are certain fund categories like GSEC funds or long duration funds, where again SEBI has categorized. But broadly, to simplify the whole thing, a fund with a portfolio maturity of say 1 year, 2 years, 3 years is on the shorter side. Something like 5 years, 10 years, 15 years is on the longer side. Now, coming to the other question, liquid funds. So, as per SEBI definition, a fund where the residual maturity of the instruments in the portfolio can be maximum 3 months. What in simple language it means is the extent of variability of the fund returns along with movements in the market will be relatively on the lower side. So, you can invest in the fund with a relatively lesser investment horizon. For example, a horizon of 1 week, 2 weeks, 3 weeks, 1 month. You can invest in a liquid fund and your returns will not be too much volatile. So if I sound technical, please let me know if I have to re-explain anything in simpler words.
Absolutely. No, no, this is a very good explanation. Thank you so much for that, Mr. Joydeep. Now, again, getting back to our first speaker, Basant, for the event. So, Basant, when you're talking about debt funds, returns, etc., वो तो सब समझ आ गया. But अब इसके ऊपर कोई tax implications भी होंगी. So, firstly, let's start discussing how are debt fund returns taxed, and also compared. Can you please compare it to the taxation of other investments?
Sure. Uh, so, returns are considered as a short-term or a long-term capital gain depending on the period of holding, and they are taxed accordingly. In case of a debt mutual fund as well as an equity mutual fund. So, if you sell your debt mutual fund holding within 3 years of the purchase, then the profits are considered to be a short-term capital gain, and the short-term capital gain is taxed as per your income tax slab rate. So if your income tax slab rate is falling under a particular slab, then your income just gets accelerated to the extent of the income from the mutual fund, and then the overall income gets taxed at the slab rate. The long term, if you're holding it beyond 3 years, then that is taxed separately at 20%. So the other thing, as within the debt space itself, if you compare it with a conventional instrument, it is important to understand that, if, for example, you are investing in a conventional instrument like an FD, you get an interest on a quarterly basis, for instance, or on a cumulative basis. But if you choose, for example, a quarterly basis, in that case, you receive interest after a TDS deduction uh, at the at every quarter, right? Uh, but in case, say for example, of a mutual fund, that interest amount continues to get reinvested uh, till the maturity. So at the maturity, when you actually withdraw the amount, and say for example, if you are invested for a period of, say for instance, 5 years, so the interest amount continues to get reinvested uh, without a tax implication until you actually withdraw the funds. So that compounding benefit is available to the investor, and then that sort of adds to the overall returns. And when you actually withdraw the funds, at that point of time, whatever is the capital gain then gets taxed based on the category, whether it's a short term or a long term. So in this case, it will be a long term capital gain.
Right. Thanks for sharing that, Basant. Prableen, would you like to add something to that?
Okay, yeah. Little, I think, in March, actually, we had a slight change which was announced by the finance minister. And for debt funds, now it is a single taxation, whether you're holding it for 3 years, 5 years, or 10 years. So it is not categorized now as short and long, actually, and it is considered as short-term capital gains, and it is added and taxed at your income slab. However, having said that, so basically the indexation benefit, Sejal, which was there, which Basant mentioned, 20% with indexation post 3 years holding period, is no longer there. But for the holdings which investors have already, if they'd invested their money before March 31st, 2023, that will continue to avail the indexation benefit. Let's say somebody invested in January this year and they invested in a instrument wherein the money will be kept for the next 5 years. So they will definitely be able to claim the indexation benefit. So that being said, the other, while the indexation benefit is not there, I feel debt funds still offer two other benefits vis-a-vis, especially fixed deposits, because fixed deposits, whether your interest is reinvested, you're taking out the money, or you're just keeping it there, the interest earned, your 26 AS at the end of the financial year will reflect that, okay, this is the interest amount that you earned, and then you are paying taxes at your slab rate there. So let's say a 7% FD, and if you're in the 30% slab, so you end up paying that percentage. So in net, what you're making is about 4.9%. In case of debt fund, Sejal, the advantage is that there is a deferred taxation. So let's say if I invest today and I'm investing in a passive debt fund which has a holding till 2020, 33, and I intend to continue till that period, I'm not paying taxes on whatever there is, whatever the amount by which my NAV has gone up or my gains, till the time I'm not redeeming my money. So there is a deferred taxation. So I think that simplifies the overall tax structure for the investors because they don't need to pay tax on a yearly basis. And I think the other advantage is because it's considered as short-term gain, it can still be, your gains which are there. And parallelly, if you have some losses in equity, so it can still be set off against your losses in equity or any other instrument. So the short-term gains can be set off. So I think, and there's deferment. So I think these two are the two advantages which are still there. Otherwise, in terms of taxation, now the indexation benefit is no longer there.
Right. Thanks for sharing that, Prableen. Joydeep, would you like to probably add something to the
Yes, I will.
taxation part
Yeah,
itself? Yeah,
yeah,
please
yeah, yeah.
go ahead.
So I will add 2 points here. In any mutual fund scheme, there are two investment options. One is dividend, one is growth. Dividend is now technically called IDCW, which stands for Income Distribution Cum Capital Withdrawal. You can forget the technicalities. Simply dividend option where the mutual fund pays a dividend at some defined or indicated frequency, like monthly or yearly or quarterly or weekly or something. In the growth option, there is no payout. So whatever is there, it's in the NAV. You invest in the fund at a certain NAV and you redeem when you want at a certain NAV. So NAV to NAV, you get your appreciation, you get your returns. Now, the dividend option of mutual funds has been made taxable even earlier, made taxable in your hands, in the hands of the investor much earlier. Now, the growth option, so what has happened is, as Prableen clarified, so from 1st of April, investments in the growth option from 1st of April, that is now defined as short-term capital gains, irrespective of your holding period. So if you invest in a debt fund today and you redeem after 1 day or 1 year or 10 years, it is classified as short-term capital gains, which is your marginal slab rate or marginal tax rate. That is first point. Next point is this compounding advantage, compounding benefit in debt mutual funds or over bank deposits. When does it work? The rule is in a bank deposit. If your interest in a financial year exceeds rupees 40,000, then there is TDS. So if your amount of deposit in the bank is rupees so much that the interest over the year is more than 40,000, that is TDS. So if your deposit is small, it does not really matter. If your deposit is sizable and the interest exceeds rupees 40,000 in a year, then there is TDS. And as Pavlin said, so when there is TDS, the responsibility of paying the balance tax is on you, on the investor. So you have to pay tax every year, actually every quarter, because you're supposed to pay advance tax every quarter. So that takes away the benefit. So like Pavlin said that 7% bank FD effectively means so much and all those things. So as a ballpark number, as a same level of return, as an example, 7% FD, which is taxable at 30%, and another debt mutual fund giving 7% returns also taxable at 30%. But in the debt mutual fund, you pay the tax at the end of your holding period. So as a ballpark, you get a 20-30 basis point, which is 0.2 to 0.3% additional higher return in the debt mutual fund due to the compounding or deferment of tax. Yeah, that's all.
Right. Coming back to another question for you, Joydeep. So, what are the factors to consider while buying a debt fund? What are the liquidity considerations? That is one. What kind of expense ratios and fees one can expect, and also like how is there any specific parameter you're supposed to judge a debt fund on?
Yeah. So firstly, before investing, the primary thing which the investor should look at, as Basant said earlier, the portfolio maturity of the fund and the investment horizon. So as I said earlier, there are 16 debt fund categories, and SEBI has defined the portfolio maturity range for most of these fund categories. For example, liquid fund maximum 3 months, ultra short 3 to 6 months, short duration 3 years. A gilt fund, it is long maturity, nothing is defined as such. So the fact sheet of the mutual fund scheme will tell you what is the portfolio maturity being done by the fund. So as an example, if the portfolio maturity is 3 months, ideally you should have a 3 year investment horizon. So if not 3 years, maybe say whatever, 2.5 years, 2 years, whatever. If the portfolio maturity of the fund is set 10 years, you should have a horizon of 10 years or 9 years or 8 years, which is basically a longish horizon. So as long as you are matching your investment horizon with the portfolio maturity of the fund, you are that much safe. Now, what do I mean by safe? In the market, variations do happen. So even the debt funds are more stable than equity. Some market fluctuations sometimes do happen. Now, when you have a long enough investment horizon, you are that much safe. As an example, if the portfolio maturity of the fund is 10 years and you have a horizon of say 10 years or 9 years or 8 years, in the interim, fluctuations may happen, but you are that much safe as long as you have a long horizon. Don't have to worry about the interim fluctuations. The other things people should look at is the portfolio composition. So, like Prableen said earlier, the credit risk. So, there are certain instruments like government security, which is considered free of credit risk. Then there are the credit ratings like AAA is highest, then AA, then single A, and that kind of stuff. So have a look at the portfolio composition, as in the credit rating of the instruments in the portfolio, plus certain other things like pedigree of the AMC, the corpus size, and certain other factors if you want, and then you can go ahead with the investment. Hello.
Right. Yeah.
Yeah.
Sorry, I think I lost connection. Thank you so much for that, Joydeep. And I would want to go to Prableen and then Basant for concluding the session. Firstly, just give me 1 minute, please. So talking about you've invested in debt funds. अब हमने पैसा तो invest कर लिया है, okay, हमें return भी मिल गया है. So what kind of exit strategy should one follow, and how often should investors monitor their debt fund investments? Prableen, please
That's
go
for
ahead.
me, Sejal. Okay, yeah,
Yes, yes,
okay.
yes, please.
So two things here. I think the first thing is that while you're investing, you should be sure about picking the right category for yourself. So let's say that you require the money for a foreign trip after 1.5 years. You should not be parking your money in any of the longer duration products. So I would say that when you're picking the debt fund, don't be tempted by, let's say, 0.5 or 1% extra returns from a certain category, and that too in the past, which you've seen. It's very important that the right category within the debt space is picked, because that will really define the returns that you make. So the first is that, and once you have clarity, on that what is the right category for you, I think the exit strategy automatically becomes simpler. So once you have your goals defined and the category, the right category is picked, you know when to exit from it. Having said that, the red flags, in case you're asking that, Sejal, of course, because any investment should be monitored. The health of the portfolio is very important, and I think we've seen in 2020, what happened with Franklin. So somewhere, you have to be careful that the credit quality of the portfolio stays good, and you have more of AAA rated and higher rated papers in the portfolio. So probably at the time when you're investing, for investors, because it's very hard to look at the portfolio and understand, there is now risk class. There's a potential risk class. There's a matrix which is given, which shows how high is the credit risk in the fund and how high is the interest rate risk. So let's say if you are somebody who's a low risk taker, and especially in the debt space, usually a low to a moderate risk appetite investor would be there. They can actually look at the fact sheet and just check how much is the credit risk. Is it A, which is low, or B, which is moderate? Likewise, how much is the interest rate risk? And I think if there is a change in that risk matrix over a period of time, and it is deteriorating in the sense that the credit risk has increased or the interest rate risk has increased in the investment, maybe that is the time to reconsider whether the fund is still suitable for you or not, and then take a decision on the exit. Also, I think one more red flag would be reduction in the AUM, a significant drop in the assets which are managed by the fund. I think that is again a red flag.
Right. Thank you. Thank you so much for sharing that, Prableen. Right. Basant, would you like to add something to that? Probably, what are parameters that one should monitor in the debt fund investments? That is one. And also, what are factors when probably someone might need to exit a debt fund?
Sure. So, you know, an investor should always look at his investment horizon. As absolutely agree with Prableen and Joydeep. In case the investment horizon is similar to the duration of the fund, and categories of fund, well articulated by Joydeep already. Uh, in that case, you can just realize returns closer to the YTM at the end of the investment horizon. But the investment horizon, if it is different from the duration of the fund, that is when you might witness a bit of volatility, because as and when you withdraw your funds from a particular mutual fund, the returns might be linked to the prevailing market conditions at the time of withdrawal. Uh, so, for instance, if your investment horizon, and this can be used for some additional benefits as well in terms of overall returns, but obviously this will have some additional risk as well. So for instance, if your investment horizon is 2 years, and the uh, YTM is, say for example, 7.5%, and you suddenly read a news that RBI has cut rates by say 0.5%, and suddenly you see a jump in your returns when you look at your portfolio the next day, um, and you decide to withdraw your investment. So which essentially means that the overall YTM would now reduce because the underlying instruments would be trading at a lower YTM, which essentially means that you get compensated for the reduction in YTM by way of your returns. So in this case, if say for example an investment is withdrawn in 1 year time, and at the time of investment your investment horizon was 2 years and the duration was 2 years, uh, and interest rates have fallen by 50 basis points, the realized return then would be closer to 8%, right? Because the remaining investment maturity is 1 year and you get the additional capital gain of 50 basis points. So, but in case, it's the other way around and interest rates have gone up, so your investment returns will reduce accordingly. So that's something that, investor needs to keep in mind. But in case, the investment horizon is similar, then the realized returns, as I said earlier, would be similar to the YTM at the time of the investment. So this is something that the investor should keep in mind while investing in debt mutual funds.
Right. Right. Thank you so much for sharing it, Basant. I would probably open the panel up for questions because this was probably the basics of debt fund simplified. And I did have a query from Mr. Ravi Handa. So, Ravi, I'll just add you as a speaker and we can probably cater to your query. I have just one request. If someone has a query, either you can DM me, or if your profile has a photo and a bio, I would probably add you as a speaker and you can please go ahead with your query. If it's anonymous account, I will prefer not adding you as a speaker. You can probably DM me your question and I'm more than happy to ask that to Prableen, Joydeep and Basant. Ravi, am I audible? I am still sending a speaker request to Ravi. Otherwise, I'll probably read his question out. Okay, Ravi is replying that his kid is sleeping, so he can't talk. But here is Ravi's query. Okay, so Ravi is asking, is there a dollar-based debt fund that we can invest in? US bond rates are close to the highest in the 2 decades. If we can invest in those, we get the dollar returns plus these high rates. Okay, so I think he's asking that probably is there any dollar based debt fund that we can invest in? Ravi, there is a certain guideline for these spaces that we do not take specific names of funds that are there, but probably we could just have some outline from each of our speakers regarding this question, like if they have any views. But we would prefer not taking any fund names because of guidelines that are there by the regulator. So, okay, let's go to Basant first, then Prableen and Joydeep. If you can answer his question, would love to hear all your views. Basant, are you there?
Yeah, sure.
Please.
An investor cannot invest in dollar bonds directly. You can look at, using the LRS uh, to sort of, push your funds overseas and invest. But there are a lot of funds, who invest in bonds, and you can actually put your rupee funds into, their uh, uh, the mutual fund, and then along with the hedging cost you get that benefit. So those funds are available, uh, but obviously, as Sejal mentioned, we cannot disclose the name of the funds, but yes.
I hope that answers your question, Ravi. Prableen, if you have any views on that, please go ahead.
So, Sejal, actually, there was NFO earlier this year by IDFC, now Bandhan, and they had come up with the US debt ETF fund, which invests in US Treasury bond with 0 to 1 year maturity. So, I would not like to go into much details, but there is a fund available now through which investments can be done, and that fund further is actually investing in a JP Morgan US Treasury bond ETF. So it's like a FOF. And through that, just the way for example, we have the NASDAQ fund. So the Indian mutual fund, is further investing into the NASDAQ index. Or we have the other funds, for example, PGIM uses the Jennison fund for global equity opportunities. Likewise, we have the JP Morgan Beta Builders US Treasury bond as the underlying fund for the Bandhan US Treasury fund.
Right. Thanks for sharing that, Prableen. I would just want to give a disclaimer to that audience. Anything that the speakers say is not a recommendation. आपको ये समझना पड़ेगा. There are names of different funds that are given. But again, spaces में जो भी discuss हो रहा है, number one, education के लिए हो रहा है. Number two, I request all my speakers from refraining taking name of any fund because we are specifically trying to make it a education space. Just a humble request for that. I'm so sorry for that. And also, at the end of the day, speak the listeners, अगर आपको किसी भी debt fund के बारे में जानना है, please go to a SEBI registered investment advisor. They will be able to help you with the right funds, or probably how your portfolio should be done. Just a request for that. And thank you for sharing that, Basant and Prableen. Joydeep, would you like to add something to that?
Yes. So this is a popular query nowadays, and it is a fact that in the US interest rates are on the higher side. But somehow, I mean, I don't mean to upset anyone, but the point which people tend to miss out is that even after US yields being on the higher side, Indian yields are even higher. So in this particular fund, which invests in US money market in instruments up to 1 year maturity, 0 to 1 year maturity. So there, as a ballpark, the portfolio yield is less than 5%. And today, our treasury bill yield, like 1 year or 6 month treasury bill yield, is like just under 5%. Sorry, just under 7%. So there is a almost 2 percentage point differential. What I'm trying to say is, even after US yields have moved up, there is a almost 2 percentage point differential between US yield and our yield. So our yields are higher. So am I de-recommending investment abroad? No, I'm not de-recommending. If you are investing in that particular fund abroad, there would be a logic. And the logic could be, one is, if you have some other purpose, for example, under that LRS to $50,000 per year, if you are sending funds abroad any which way, for example, it could be a foreign trip, it could be son, daughter education, or whatever that thing is, instead of keeping it in some savings account, you can invest in this particular fund. Now, you can invest in equity funds also, but the point is, equity funds are more volatile, and if your horizon is shorter, debt funds would be less volatile. The other this thing is that the rupee depreciation benefit. So any investment abroad, it could be equity fund, debt fund, or a gold fund. So as and when rupee depreciates, when you redeem along with the returns of the fund per se, you get the benefit of rupee depreciation also. That is another added advantage of investing in rupee in a fund that is investing abroad. Yeah.
Right. Thank you so much for sharing that, Joydeep. Ravi, I hope that answers your query. I see Mr. Vinod. I will just add you as a speaker and you can ask your query. I see someone called Profit Must as well, IPO India. I would request you either come from your, personal account, or you can probably DM your query, please. Yeah, Vinod, go ahead. Vinod, are you
Yeah,
there?
I'm there. Yeah. Good evening, everyone.
Okay. Right. Good evening, Vinod. Please go ahead with your
Yeah,
query.
ma'am. I would like to share some knowledge on debt funds, which I may be having a little bit of knowledge. Regarding the deferred taxation, I would like the listeners to know that if you are really not taxable to income in your regular other income sources, so you can redeem some of the uh, funds periodically, so that you are not taxed according. And when you go for a deferred tax, you might today be at a 10% slab. Tomorrow, if you are a long investor, you might have to go into the 20 or 30% slab. So that would cost you actually more. Because in my case,
Right.
it is so. In my case, it is so. I am mostly invested in tax-free instruments like PPF
Right.
and tax-free bonds.
Right. Right. Thanks for sharing that, Vinod. I would request all my listeners that, probably Vinod has a different skill set. I will just mute you, Vinod,
One,
please.
one, one,
But, Vinod, I would request that if you have any specific questions, we could pertain to that, as tax planning is personal to every person, and a CA might be the best guide for tax planning. Just a request for that, please. Right. So, just a disclaimer to all my audiences, at the end of the day, probably going to a professional to help you plan your taxes better, or how you can, manage your portfolio and, pay the right amount of taxes, it is always better to go to a CA. Just a disclaimer for that. Anything that is said on the space is specifically for education. And if you have any queries, please go to a professional, or you can DM the speakers directly for any specific recommendations or names. Nothing on this space is a recommendation, it is just for education. Just wanted to mention that. And we have IPO, there is IPO India who has sent a speaker request. I will request you to DM your query, as this is not a personal account and I would not be taking an anonymous account. Okay, we have someone called Mr. Rahul. He is a professional bond trader and I'll just add him as a speaker. This is the last speaker for today. Hi, Rahul, are you there? Rahul?
Hello.
Yeah,
Yeah,
hi.
hi.
Please go ahead with
So
your
just
question.
wanted to check. So SEBI recently introduced a corporate debt market development fund, wherein in times of distress they could buy out bonds from mutual fund above investment grade. So just wanted to check. So how does it pan out for credit risk fund? Because this was the category of funds which suffered a lot after the Templeton's fiasco. So post this new development setup of this new fund from SEBI, does the risk in the credit risk fund is reduced to certain extent, especially the liquidity risk?
Right. Would any of the speakers want to answer this question?
Yeah.
Sure, I can
So,
take that. So
Okay, so
Joydeep, please go ahead.
Joydeep first, and then Basant can answer your question, Rahul. Yeah, please go ahead, Joydeep.
yeah. So as Rahul said, it is a reaction of SEBI to the Franklin Templeton fiasco. Just to put in context, whatever happened in Franklin fiasco, the popular perception it was a credit issue, but it was not really so much of a credit issue, more of a liquidity issue. So let me clarify what is credit and what is liquidity issue. Credit issue is starting from ILFS in September 2018 and all the way through 2019, there were multiple defaults. Up to the first week of March 2020, with the Yes Bank 81 default, there were a series of defaults, and there were, I mean, most of the mutual funds in the industry, credit risk funds, and other funds also, they were impacted by this. So this was a default or credit issue. Now, what happened in Franklin Templeton is that in March 20 and April 20, which was the initial phase of COVID, things were really unsettled. And whatever little liquidity was there in debt market was in government securities only. And in corporate bonds, liquidity was completely shut. And in that situation, there was a spate of redemption in Franklin Templeton funds. To put in simple language, unka portfolio आधा हो गया. There was so much of redemption requests. Now, what happens is when the market is illiquid, market is anyways illiquid, and in that phase, liquidity was even more scarce. So when you try to sell a bond, you suffer liquidity cost or impact cost. As an example, if the rightful price is 100, you have to sell at 99.5 or something in that range. So when they were facing so much of redemption, this thing, to a certain extent, they managed, as in half of their portfolio, they managed and they sold bonds, instruments in their portfolio. Beyond a point, they could not manage. उन्होंने हाथ खड़ा कर दिया. They tried various things. So, little bit of technical this thing. A mutual fund is allowed to borrow 20% of the portfolio to be redemption. They got special SEBI permission to borrow up to 40%. So, whatever they tried, ultimately in the illiquid market, उनसे नहीं हुआ. उन्होंने हाथ खड़ा कर दिया. They just shut down those six funds which you all know. What I'm trying to say is that it was more of a liquidity issue and not so much of a credit issue because there are other mutual funds in the industry, I will not name them, who suffered an even bigger impact of defaults than those six Franklin Templeton funds. That was the background. Now, coming to the question, does it reduce the credit risk or liquidity risk in the industry? So, on the credit risk, this fund per se does not reduce the credit risk. Risk is better because of other reasons, because that credit default cycle starting from September 18 to March 20 was due to entirely different reasons. Well, like I said, long this thing. Those reasons are not there or reduced to an extent, so that risk is anyway lesser than earlier. On the liquidity, yes. So what this fund will do is the 33,000 crore. So it will be done by one particular, again I'll not name, one particular fund house as an AIF. So whenever there is a run on liquidity in the industry and there is no one to buy, and that leads to negative impact cost, mutual funds can go to this particular fund house run AIF and they can offer to sell these illiquid bonds or bonds not selling at that particular time. So that koi lene wala hai, and that kind of fiasco hopefully would not offer again. So the liquidity risk to a large extent is addressed by this fund. Yeah.
Right. Thanks for sharing that, Joydeep. Now coming to Basant, probably you can answer Rahul's question, and I also, how will AMCs use this option if they had to use it?
Sure. Uh, so, absolutely agree with Joydeep. But just one point to add there that, you know, in terms of a, credit event, if a credit event gets, impacts a particular security, then the security valuation gets marked down. What this fund would do is buy the security at a particular valuation. So, in case a credit event happens, the valuation drops down, say for example, to zero, then there is no realizable value left in the security, right? Uh, in case of a liquidity event, the uh, valuation of the security will not move significantly just because the security has become illiquid. So therefore, at that valuation, say for example, if the valuation of the security is at 7.5%, and because of liquidity issues, yields have gone up, and the security is valued at say 7.75%. So then the security gets valued at 7.75%, and the security is bought by that specific entity, the AIF, as Joydeep mentioned, and the amount is realized by the specific AMC to meet redemptions. So that's how essentially it would work. So the mutual fund requests that AIF that this is a particular security that's turned illiquid. It's not tradable anymore, and therefore the securities are actually transferred to the specific AIF. The AIF in turn provides the realizable value of the security to the AMC, and the AMC meets the redemption. So that's how it works in practice.
Right. Thanks for answering that, Basant. Rahul, I hope your question's answered.
Yeah, it is answered. I would just like to add that, I mean, earlier what used to be happen that even if there is a single credit event, even other funds which do not have credit event used to get impacted because there used to be redemptions. So they used to sell even AAA, AA plus bonds at, I mean, a 10 to 15 basis higher than what the market rate was. So I think this particular facility would help in that context, that it would stabilize the, I mean, returns from the category, is what I was, yeah.
Right.
Uh,
Thanks.
just to add, Sejal, if you allow.
Please go ahead. Please.
Yeah, so Rahul, I don't think this fund is meant for that purpose. It is meant only for a systemic risk. If the security is, can be sold at a 15 basis point, upward yield as well, then that will not be considered as an event which necessitates the activation of the AIF. It will happen only if the security becomes completely illiquid, and not because the returns might get impacted, right? So that
So,
needs to be
just
kept in
wanted
mind.
to understand systemic event, as in, for example, if any particular, I mean, say, for example, the DHFL fiasco happens. So, if this particular event happens in future, some big NBFC or some big credit goes down, will that be considered a systemic event, and then will this fund be available for purchase of securities from debt funds?
No. So how it would work is that, say for example, I have a fund of 5,000 crores, and I in one day, receive a redemption request of say 40% of the AUM, and a very unlikely event. But if something like that happens, now my ability to redeem securities to the extent of 40% might be difficult, given the constraints that I may have as an AMC. So in such cases, when I'm not able to realize the security because, say for example, the market has become illiquid, uh, and as Joydeep mentioned, there are various options available. You are necessitated to keep a minimum of 10% liquidity in case of non-liquid funds, and 20% liquidity parked in highly liquid securities like treasury bills or cash in case of liquid funds, and the option to borrow another 20% against these government securities that have been pledged. So if that 20% is still not able to meet, and I'm not able to sell those securities, only in those cases that gets activated, and that has to be approved by the trustees. So it's not something that can be used in a normal course, or an event driven by one single credit.
Right. Thanks for answering that, Basant. Rahul, if you have any further queries, you can probably personally DM Basant, and if he is happy to discuss that further, then he can probably take that conversation ahead with you in the DMs. I would like to thank all the speakers who joined in today to discuss debt funds and simplified it for us. So before we close the space for today, I would want to take parting notes from all the speakers: Prableen, Joydeep, and then Basant.
Okay, Sejal. So I'll start by reiterating that none of the names which are taken are a recommendation. It was only for giving an explanation, and so because you were emphasized on it, so I thought I'll do that. And I'm now looking at your reactions. Okay. Thanks for the invite. And I think my parting notes are that I think debt funds are a wonderful space, and especially for those who are starting off with their investments, I think do an SIP in a debt fund as well. That is the corpus that you'll create, for your travel, for bigger expenses, and that will help your long-term goals, because then you don't, sort of go back and redeem from your equity funds. So parallelly create something through an SIP in a debt fund, so that for your requirements along your journey, and purchases and travel requirements and other things, your equity investments are they remain untouched. So that would be my I think request to those who are starting off with investing, especially youngsters.
Absolutely. Thank you. Thank you so much, Prableen. Joydeep, please go ahead.
Yeah, so I'll make 2 points. As I said earlier, people have this FD mindset. What it means is, in an FD, bank ने लिख के दे दिया 7%, so people can actually expect 7% returns. In fixed income mutual funds, even though it is called fixed income, it is not really fixed. The reason is the NAV, which is declared every day or every working day. The securities in the portfolio are valued at market levels. It is not actually sold, but in case the securities are sold, what would be the market realization level? Which means the NAV is subject to fluctuation. So which is why it is not really fixed. However, having said that, like we discussed earlier, if you can match your investment horizon along with the portfolio maturity of the fund, you are safe to that extent. As an example, if a horizon is 1 year, invest in a fund with a 1 year portfolio maturity. Horizon of 3 months, invest in a fund with a 3 month portfolio maturity. And other point is there is something called laddering. Laddering means matching this thing. So, like Praveen said, if you have a foreign trip after 2 years, you invest in a fund with a portfolio maturity of 2 years and it matures thereafter. So, anyway, what you can do is you can use your debt mutual fund portfolio to behave like a bank FD kind of portfolio, and it is liquid any which way. You can put in the redemption any day, and you get the money T+1 or T+2, which means next day or day after. In a bank FD, there may be a premature withdrawal penalty. As an example, in a 7% bank FD, if you invest for say 3 years and if you redeem after 1 year, of course you can, but there may be a premature withdrawal penalty. Whereas in a debt mutual fund, of course, the funds with no exit load, there is no penalty and you can exit any which time. Yeah.
Right. Thank you so much for sharing that, Joydeep. Now going to Basant. Please go ahead, Basant.
Sure. So in terms of a debt instrument, one needs to understand that there are three broad parameters that need to be considered. One is liquidity. You irrespective of the duration of the instrument, irrespective of your time horizon, you can realize your funds on a T+1 basis if you have made a redemption request before say 3 p.m. or on a T+2 basis if you made a redemption request after 3 p.m. So the liquidity is always available. The second is diversification. You are not looking at one entity for investment. You are diversifying your debt investment also across the curve, across various entities. And third is return visibility. If the duration matches, your investment horizon, then you can look at your returns with sufficient visibility. And lastly, you can also look at optimizing your returns uh, if you have a higher risk horizon.
Right. Thank you so much for sharing that, Basant. And I'd like to thank all my listeners who joined in today to, learn about debt fund speakers who gave us our time. Thank you so much, Joydeep, Prablin, and Basant for joining in. Joydeep, do you want to say something?
Yeah. Look forward to working with you again.
Oh yeah, absolutely. Would love to host you as a speaker on one of my spaces. Thank you so much for that. And अगर आपको टू माय ऑडियंस, अगर आपको आज का स्पेस अच्छा लगा, इसके बारे में ज़रूर शेयर करिए कि ज़्यादा से ज़्यादा लोग इन स्पेसेस में आएँ और सीख कर जाएँ। एंड अगेन जस्ट अ डिस्क्लेमर, ये जो स्पेसेस में जो भी डिस्कस होता है, इट्स फॉर लर्निंग पर्पस, नॉलेज पर्पसेस, एंड नथिंग इज़ अ रिकमेंडेशन। अगर आपको अपने पोर्टफोलियो स्पेसिफिक एडवाइजरी चाहिए, प्लीज़ एक सेबी रजिस्टर्ड एडवाइज़र के पास जाइए, उनको फीस दीजिए एंड फिर उसके बाद उनके एडवाइस इम्प्लीमेंट करिए अपने पोर्टफोलियो के लिए, बिकॉज जो प्रॉब्ली बसंत या जॉयदीप या प्रबलीन के पोर्टफोलियो के लिए वुड नॉट वर्क फॉर सेजल्स पोर्टफोलियो. सो एवरी वन हैज़ अ डिफरेंट काइंड ऑफ नीड दैट दे हैव फ्रॉम द पोर्टफोलियो एंड एवरी वन हैज़ अ सर्टन गोल. तो सबका सेम नहीं मैच होता है. सो अगेन, nothing in the space is a recommendation, and I look forward to hosting you again. Thank you so much to all my listeners and speakers. This is Sejal Sood signing off. I'll just end the space. Thank you. Bye.
Thanks, Sejal.
Bye.
Thanks.